In late 2025, headlines exploded with claims that Europe was dumping U.S. Treasury bonds in retaliation for Trump's sweeping tariffs on European goods. The media painted a picture of a brewing financial storm, suggesting that the very foundation of global economic cooperation was under threat. It was described as a financial war between old allies, with both sides supposedly preparing for economic battle. According to these stories, Europe was actively destabilizing the U.S. debt market, liquidating trillions in government bonds and sending shockwaves through Wall Street. If this narrative had been true, it would have marked a historic rupture in transatlantic trust, with consequences for global markets and political alliances. But the reality, as is often the case, was far less dramatic and much more nuanced. There was no mass sell-off, no sudden collapse in the U.S. bond market, and no coordinated European action to undermine American finances. In fact, European nations hadn't dumped U.S. debt at all. The story was a dramatic exaggeration, confusing internal contingency planning with actual real-world events. The real story? European officials did discuss the idea privately, but only as a last resort option, something to keep in their back pocket, not a policy to put into action. These were strategic, behind-the-scenes conversations, not public threats or concrete steps taken against the U.S. sensationalist headlines took these confidential debates and spun them into a narrative of open conflict, fueling public anxiety and speculation about a looming economic showdown. The gap between the dramatic headlines and the quiet reality was immense, highlighting how easily rumors can overshadow facts in today's fast-paced news cycle. At the core of the misunderstanding was a simple but critical error, mistaking a whispered threat for an actual action, and contingency planning for a declaration of war. In the end, Europe's so-called sell-off was just a whisper in the halls of power, not a war on the world stage. Why would Europe even consider such a drastic move? Two words: tariffs and Ukraine. In April 2025, Trump's new tariffs on European goods reignited trade tensions, signaling a shift in U.S. priorities. At the same time, U.S. diplomatic overtures to Russia stoked fears in Europe that American support for Ukraine might waver. European leaders felt squeezed, economically by tariffs, and strategically by the risk of U.S. disengagement from Eastern Europe. The idea of selling U.S. debt emerged as leverage, a way to remind Washington that Europe had tools of its own. It was a warning. Europe's security and economic partnership aren't one-way streets. The threat was about deterrence, not destruction. Europe's threat carried weight not just because of political alliances or diplomatic influence, but due to a far more tangible factor: money. Europe's leverage stems from its massive U.S. debt holdings, which have quietly grown over decades of economic partnership and global trade. Collectively, EU nations and the UK now hold over $2.3 trillion in U.S. Treasury securities, more than China, and second only to Japan. This makes Europe a critical player in the world's largest bond market. These vast holdings are the result of decades of trade surpluses, robust exports, and the global trust in U.S. treasuries as the world's safest asset. For many European nations, investing in U.S. debt has been a way to safeguard national wealth and stabilize their own economies. Europe is a pillar of the U.S. debt market, providing essential depth and liquidity that keeps the system running smoothly. Without Europe's participation, the market would be far less stable. If Europe ever coordinated a large-scale sell-off, the market couldn't absorb it without chaos. Prices would plummet, interest rates would spike, and global financial stability would be threatened. That's why it's called the nuclear option. A move so destructive it would hurt both sides, causing economic fallout that would ripple across continents. The real power isn't in actually selling, but in the credible threat that it could happen. This threat alone can influence negotiations and policy decisions in Washington. This financial interdependence is both a shield and a sword, binding the two economies together in a delicate balance of trust and caution. Europe's leverage is real, but using it would be mutually destructive, undermining the very stability both sides depend on. The nuclear option is a deterrent, not a strategy. It's a last resort, meant to prevent reckless moves, rather than provoke them. The relationship is too intertwined for reckless action. Every decision reverberates through a web of economic connections. In the end, the threat alone is enough to get Washington's attention, and to remind both sides just how much they have to lose. Despite the headlines, there was no coordinated European rush to sell US treasuries. The idea was discussed quietly among top officials as part of routine contingency planning. Governments always prepare for worst-case scenarios. This was just one of many. The nuclear option was a strategic whisper, not a public threat. By leaking the possibility, Europe signaled its displeasure to Washington without escalating the crisis. Official statements remained calm, emphasizing financial stability. The ambiguity was intentional, forcing U.S. policymakers to consider the risks. The headlines confused consideration with action. Europe flexed its financial muscles through subtle signaling, not open confrontation. The sell-off was a ghost, powerful in theory but never real. What if Europe actually dumped $2.3 trillion in U.S. treasuries? It's a scenario that sounds almost unthinkable, but let's imagine the consequences. The sheer scale of such a sell-off would send shockwaves through the global financial system, shaking the very foundation of international markets. The result? Bond prices would crash almost instantly, interest rates would soar to levels not seen in decades, and the U.S. government's borrowing cost would skyrocket. Investors everywhere would scramble to adjust, and panic could spread quickly. Mortgage rates, car loans, and credit cards would become unaffordable for millions of Americans. Homebuyers would be priced out, businesses would struggle to get loans, and families would feel the squeeze. The economy could grind to a halt, likely triggering a deep and painful recession. The shockwaves wouldn't stop at America's borders. Global markets and currencies would be thrown into chaos, as investors everywhere tried to protect themselves from the fallout. International trade would slow, and uncertainty would grip economies worldwide. The dollar could plummet in value, and a sudden liquidity crisis could spark a chain reaction of defaults, bankruptcies, and bank failures. Headlines would scream of financial crisis, and confidence in the global system would be shaken. Europe would suffer too. Its exports would collapse as the U.S. economy faltered, and its banks, heavily invested in U.S. assets, would be hit hard. Factories could close, jobs would be lost, and the pain would be felt on both sides of the Atlantic. This is why the so-called nuclear option is really a form of mutual assured destruction. It's a weapon that, if used, would devastate both sides and leave lasting scars on the global economy. The threat itself works as a powerful deterrent, keeping both sides in check. It's not meant to be a real policy, but a warning of the risks of escalation. Both sides would lose, governments, businesses, and ordinary people alike. That's the point. No one escapes unscathed. The real power is in the threat, not the act itself. It's a high-stakes game of brinkmanship, where everyone knows the cost of going too far. In the end, no one wants to pull the trigger, because everyone stands to lose everything. Despite the drama, foreign demand for U.S. treasuries remains strong. After a brief dip, investors poured over $300 billion back into U.S. debt in 2025. U.S. treasuries are unmatched for safety, liquidity, and scale. There's simply no alternative. Even as political tensions rose, Japan and Eurozone countries increased their holdings. The Sell America panic lasted barely a week before reversing. Analysts agree, there's no evidence of sustained foreign selling. Headlines may spook markets, but the underlying demand for U.S. assets is resilient. The U.S. Treasury market is the world's ultimate safe haven. Until a credible rival emerges, global investors will keep buying American. The system endures because it works. Political drama rarely trumps financial reality. 2025 was a wake-up call for Europe. Reliance on the US dollar is a vulnerability. The nuclear option is too risky, so Europe is seeking more financial independence. The leading idea? Eurobonds. Joint EU debt that could rival US treasuries as a global safe asset. Once controversial, Eurobonds are gaining support among economists and policymakers. A large, liquid Eurobond market would boost Europe's financial sovereignty and the euro's global role. It's a long-term project, requiring deep political trust. In the meantime, Europe is slowly diversifying reserves, adding other currencies and gold. This isn't panic selling, but prudent risk management. Europe is building its own financial fortress, step by step. The goal? More options, less dependence. The story of Europe dumping US debt was more fiction than fact, a case of headlines outpacing reality. The real events were about strategic posturing, not economic war. No mass sell-off happened. The threat was a whisper, not a weapon. Sensationalism blurred the line between planning and action. The US financial system remains robust, anchored by trust and a lack of alternatives. Europe's true strategy is long-term, building autonomy, not triggering chaos. The real shift is slow and structural, not sudden and dramatic. The world is moving toward a more multipolar financial order. The headlines missed the nuance, but the underlying change is real. The tectonic plates of global finance are shifting, quietly but surely.